gift tax and estate tax. After 1976, the taxation of gifts and estate tax are treated essentially as a unified system. Transfers during lifetime are considered gifts. Transfers after death are treated as related to the estate tax. Generally, such transfers never result in a tax actually being owed. Exclusion, deductions, and credits have major impact that lessen the likelihood of a tax being owed. It should be noted that gifts and inheritances are never considered as income for income tax purposes. The gift tax and estate tax are separate categories of taxation, distinct from the income tax system. Gift tax, Form 709. In general, if you are a citizen or resident of the United States, you must file a gift tax return whether or not any tax is ultimately due in the following situations. If you gave gift to someone in 2018 totaling more than $15,000, other than to your spouse. Certain gifts called future interests are not subject to the $15,000 exclusion, and you must file Form 709 even if the gift was under $15,000. Spouses may not file a joint gift tax return. Spouses file gift tax returns to split gifts with their spouse, regardless of the amount. Only individuals file gift tax return, not entities. The donor, the one giving the gift, is responsible for paying the gift tax. However, if the donor does not pay the tax, the person receiving the gift may have to pay the tax. If a donor dies before filing a return, the donor's executor must file the return. A gift is any transfer to an individual, either directly or indirectly, where full consideration, measured in money, is not received in return. Gifts are valued at their fair market value on the date of the gift. The general rule is that any gift is potentially taxable. However, there are exceptions to this rule. The following are non-taxable gifts. A taxpayer and their spouse can give up to $30,000, split evenly between them, to a third party without making that gift taxable. Taxpayers need to consider one half of the gift as from them and one half as given by their spouse. Gifts that do not exceed the annual exclusion amount for the calendar year, currently $15,000. A taxpayer's gifts to their spouse. Gifts to charities. Tuition or medical expenses that a taxpayer pays directly to a medical or educational institution for another person. Gifts to a political organization for its use. All of these are reasons to not include gifts as a taxable gift. The gift tax calculation. We start with taxable gifts this period. We add taxable gifts from prior periods, and we then arrive at cumulative taxable gifts. We multiply cumulative taxable gifts by the gift tax rate applicable, and then we arrive at tentative tax. We then subtract the tax on taxable gifts for prior periods that was paid up for prior periods, and we then end up with the tax on gifts for this period. We then subtract the unified credit and then come up with tax owed for the current period. The generation skipping transfer tax, the GST. This is the third of three transfer taxes: gifts, estate, which we'll be talking about shortly, and the third is this generation skipping transfer tax. The rate is a flat 40%. If there is a taxable distribution, there needs to be filed Form 706 GS for each skip person. A skip person is a descendant 2 or more generations below the giver, basically grandchildren and beyond. All taxable distributions are subject to the GSE tax, and a taxable distribution is a distribution to a skip person. The purpose of the generation skipping tax is to assure that gifts, even those given a couple generations below, are subject to some sort of taxation upon transfer. Form 706, the United States Estate Tax Return. The executor of a decedent's estate uses Form 706 to figure the estate. This tax is levied on the entire taxable estate and not just on the share received by a particular beneficiary. So that again is Form 706 is used to figure the estate tax. For decedents who died in 2018, Form 706 must be filed by the executor of every U.S. citizen or resident who, if we look at letter A, whose gross estate plus adjusted taxable gifts and specific exemption is more than $11,180,000. Again, $11,180,000. Or letter B, whose executor elects to transfer the deceased spouse unused exclusion amount to the surviving spouse, regardless of the size of the estate. To determine whether a return must be filed for the estate under letter A, add the adjusted taxable gifts made by the decedent after 1976 and the decedent's gross estate valued at the date of death. The due date of the estate tax return is 9 months after the decedent's date of death. However, the estate's representative may request an extension of time to file the return for up to 6 months. This automatic 6-month extension of time to file the return is available to all estates. Gross estate. The estate tax is a tax on the right to transfer property upon death. It consists of an accounting of everything owned or certain interests held by a decedent at the date of death. Decedent is the person who has recently passed away. The fair market value of the items owned, not necessarily what was paid for them or what their value is, what their value was when acquired, is that fair market value is how we value the gross estate. So the total of all these items is the gross estate. And again, that's the fair market value of the items owned by the decedent on the date of death. That makes up the gross estate. The gross estate includes all property in which the decedent had an interest, including real property outside the United States. It also includes certain transfers made during the decedent's life without an adequate and full consideration in money or money's worth, in other words, gifts. Gross estate includes annuities, the taxable portion of joint estates with right of survivorship, the includable portion of tenancies by the entirety, certain life insurance proceeds, even payable to beneficiaries other than the estate, property over which the decedent possessed a general power of appointment, dower or courtesy of the surviving spouse, and also community property to the extent of the decedent's interest as defined by applicable law. So those are some specifics, but our general rule is what did they own on the date of death, and we include that at market value on the date of death. Jointly owned property. Qualified joint interests held by decedent and spouse. A joint interest is a qualified joint interest if the decedent and the surviving spouse held the interest as tenants by the entirety or joint tenants with right of survivorship if the decedent and the decedent's spouse are the only joint tenants. Include 1/2 of the value of qualified joint interests. All other joint interests include the full value of the jointly owned property in the gross estate. However, full value of jointly owned property does not have to be included in the gross estate if it can be shown that any part of the property was acquired with consideration originally belonging to the surviving joint tenant or tenants. In this case, we may be able to exclude from the value of the property included in the estate an amount proportionate to the consideration furnished by the other tenant or tenants. Deductions from the gross estate are available. A marital deduction. One of the primary deductions for married decedents is the marital deduction. All property that is included in the gross estate and passes to the surviving spouse is eligible for the marital deduction. The property must pass outright. In some cases, certain life estates also qualify for the marital deduction. The charitable deduction. If the decedent leaves property to a qualifying charity, it is deductible from the gross estate. Mortgages and debts of the decedent are considered to be deductible. Medical expenses of the decedents are deductible. Administration expenses of the estate are deductible, as well as losses incurred during the administration of the estate. Those are deductible. The estate tax calculation. Take our gross estate, subtract our deductions, arrive at taxable estate. Add to that adjusted taxable gifts, come up with the estate tax base. Multiply that by the estate tax rate. Subtract from that any gift taxes paid, the unified credit, any state death taxes paid, or other credits such as foreign tax credit, and then arrive at the estate tax payable. The alternate valuation date. If an alternate valuation is elected, value the property included in the gross estate as of the following dates, as applicable. Any property distributed, sold, exchanged, or otherwise disposed of, or separated or passed from the gross estate by any method within 6 months after the decedent's death is valued on that date of distribution, sale, exchange, or other disposition. Value on the date of death it ceases to be part of the gross estate. For example, on the date the title passes as a result of its sale, exchange, or other disposition. Any property not distributed, sold, exchanged, or otherwise disposed of within the 6-month period is valued as of 6 months after the date of decedent's death. We cannot elect alternate valuation unless the election will decrease both the value of the gross estate and the sum, reduced by allowable credits, of the estate tax and generation skipping taxes payable by reason of the decedent's death. So, to summarize, an alternate valuation date can be chosen. That's typically 6 months after the decedent's death. However, if property is disposed of before that 6 months is up, we would value it on the date of disposition. We can only choose the alternate valuation date if, number one, the gross estate is reduced, and secondly, it reduces the estate taxes. Some questions and problems. Jimmy made several gifts during the year. He gave his niece $8,000 as a graduation gift. He paid $18,000 college tuition for his nephew, and he gave his daughter $25,000 as a wedding gift. Jimmy's not married. What are his taxable gifts? Well, the gift to the niece of $8,000 is just easily cleared out by the annual exclusion. The college tuition for the nephew, we're assuming that this tuition was paid directly to the school, which is a requirement. And in that case, we'll consider it to be part of the educational exclusion, and we can clear out all of it. The wedding gift to the daughter is really just sort of a straightforward kind of gift, and we can take the annual exclusion up to $15,000 per donor for each donee of $15,000, and so that leaves us with $10,000. So our answer is $10,000. Lanny won $10 million at a casino in 2016 and invested in mutual funds. When he married Judy in 2017, they signed prenuptial agreements. Then in 2018, Lanny decided to give away some of his money. He made the following gifts: $100,000 in cash to his wife, Judy, $50,000 to each of his 3 adult children, and $50,000 to the Democratic Party. What are his taxable gifts? Well, gifts to the spouse, fully excludable under the marriage exclusion. Gift to each of the 3 adult children. Each of the $50,000 given from one donor to one donee is eligible for a separate annual exclusion. So $50,000 minus $15,000, each of them taxable at $35,000. The gift to a political party, fully excludable, so not includable. So the total, $105,000. Charlie died June 15th of 2018. Gross estate $900,000. By what date is his estate tax return due? Well, the answer is it's not due, because the estate is less than $11,180,000, and we don't know of any other reasons that would cause a need to file the estate tax return. So there is no filing requirement. If, in fact, there was a filing requirement, if a return was due, the due date of the estate tax return is 9 months after the decedent's date of death. However, representatives may request an extension of time to file the return for up to 6 months. This is an automatic 6-month extension. And then lastly, Chester is preparing the estate tax return. Form 706 for his deceased brother, John. John died December 15th, 2018. Which of the following will not be included in the gross estate? Well, let's look at these. Real estate that will be passed to John when his parents die. that would not be included. That's our answer right there. Stocks and bond owned by John, those are very straightforward. Yes, they'd be included. Land John had signed a contract to sell but had not completed the sell, well, that still would be John's property on the date of death, so it's included in his estate. And property jointly owned by John and his spouse, well, that would be one half of that would be included in his estate. Well, I hope that that's been helpful, and we appreciate you listening. I know there were a couple of hiccups with some of the wording, but I hope that along with the PowerPoint slides, that it was still very sensible to you and helpful in your preparations.